Hello, my name is Rafi Gold. This is the Investigator, and today we're going to be talking about why I think GCT GigaCloud Technologies is a very undervalued company and why I think it's a good buy. So, how the company works. So, basically, GigaCloud Technology operates as a global B2B e-commerce platform that simplifies the buying and selling of large parcel merchandise, such as furniture and appliances. It connects manufacturers, primarily in Asia, with retailers worldwide, providing an end-to-end solution that handles logistics, warehousing, and delivery services. Instead of suppliers and buyers managing complex shipping arrangements, GigaCloud streamlines the process by leveraging its network of warehouses and third-party logistic providers to deliver products quickly and efficiently. This model reduces costs, eliminates the needs for inventory storage, and enables the business to scale without building their own infrastructure. So let's say I'm a couch maker in Seoul, Korea, and I want to go deliver my super cool couch to Atlanta, Georgia. If I'm a couch maker in Seoul, Korea, I have to go find a truck company that's going to go do the first mile. Then I have to find someone that's going to bring it from a warehouse to the cargo ships. Then I'm going to have to find a cargo ship company to take all these couches and bring them over to the US. I'm going to have to go find another shipping company or trucking company that's going to take the couch from wherever it lands in California all the way to here, stored in a warehouse, and then I'm going to have to figure out how I'm going to get it from inside a warehouse somewhere in Georgia into the store. So there's a lot of steps. It's a big pain in the ass, and GigaCloud Technologies basically says, look, just give us the couch. We'll handle all the shipping. You give us like 100 couches. We'll handle all the shipping. Don't even worry about it. You just pay one fixed fee, and you don't have. It's like a pain off your mind. That couch is getting delivered in Georgia, and you don't have to worry about it anymore. Um, so let's talk about a little bit more how their operations work. So their operations are centered around these 24 warehouses that they have, which they're renting, not buying outright. As you can see, they're super big warehouses. They're storing probably thousands and thousands of couches, tables, large parcel items basically. And you can see they operate primarily in North America, in Europe, in Australia, and then these Asia ones are probably where they're holding the couches for them to be shipped out from because it's primarily delivering couches made in Asia to these other countries. So by having these warehouses, it allows them to position near major ports and distribution hubs, which shortens transit times, ensuring faster shipping for retailers and customers. It lowers costs by centralizing storage and bulk shipping agreements to help cut transportation costs and making international trade more affordable and scalable, and products can be delivered closer to their final destination, reducing the need for suppliers and retailers to maintain their own costly inventory. So, another thing that I should mention is that they don't actually own this ship. They don't own this truck. All they own are these warehouses, and they're gonna go and they're gonna talk to the ship company, and they're gonna be like, "Hey, we have these couches that we need to deliver," and they're gonna arrange a time with this truck company, with this ship company, with this truck company. But basically, they handle all the arrangements. So the person shipping the truck and the person, or this person shipping the couch, excuse me, and the person receiving the couch don't have to do any of that work. So although they don't actually own these trucks or ships, they're the one that's managing all the delivery. So now we're going to go into a little bit about more of the fundamentals and why I think this stock is a buy. So the stock is not a compelling buy because it's a groundbreaking business. I mean, they're just like handling shipping. They're not like Nvidia, which are making the powering the AI revolution, but they're just extremely undervalued. GCT currently trades at a PE ratio of just 5.42, which is significantly lower than the S&P's average of 27.1. So almost more than 5 times cheaper than based on profits to an S&P stock, and based on its super high compound annual growth rate, it's 2026, just next year's forward PE is 3.88, and based on a current stock price of 18.52 and an estimated earnings per share of 4.78. This means that for every $3.88 invested, the company is projected to generate $1 of profit in the year 2026 alone. So let's get into some more value metrics now. They have a PE of 5.55 compared to the S&P average of 27.1, forward PE of 3.88, and a price to sales of just 0.65. So investors are paying just 65 cents for $1 of sales, which means that, and this is not like a truck company or a car company or a CVS or a company with shitty, terrible margins that has like huge amounts of debt. They literally have no debt. All their debt is just their leases. They don't have any actual like loans from any banks. So they have no debt on their balance sheet. They have a super high amount of cash and assets actually on their balance sheet, and they're making a dollar of sales for every 65 cents that you pay. So they're making almost double their market cap basically in money per year. And they also have huge growth. They have revenue growth projected of 43% year over year. That's insane. 43% growth. And earnings growth is even higher at 55% year over year. So this company is growing much faster than any company, or not any company, but the majority of companies in the S&P. And yeah, so they have insane compound annual growth over the next few years, and they're already super cheap just based on now. That's not even accounting for their growth. Some more profitability metrics. They have a gross margin of 26%. That's really high. An operating margin of 13%. So they're basically keeping 13 cents for every dollar that they spend. And based on the business that they're doing, that's pretty good margins. They have free cash flow of 122 million. So they're making a profit. It's not like they're losing money. They're making money. They're already an extremely profitable company. Super low risks. They have a uh, debt to equity ratio of 1.26. But even that is all that debt is just leases. So in reality, they have no debt, and they have over $1 billion in net assets, like their leases and their stuff that they have in their warehouses and their technology is all worth more than their entire market cap alone, and that's not even accounting for the money that they're bringing in. Um, so yeah, then we got to talk about some why it's been on the downtrend. As you can see, earlier this year it was trading at $44, then it came down to 15, came back to around 15 here, and now it's starting to go back up again. This is the 4-hour chart, by the way, on GCT. So this is why I think GCT has been on such a downtrend. So basically, as you can see here, sell, sell, and these are not tiny cells. These are ginormous cells. Sell 4 million, sell 4 million, sell, 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 sell 10 million, 58 million. I mean, that's literally giant. That's literally almost 10% of the whole company being sold. So why are all these people selling? Well, the truth is, it has a super high amount of inside ownership, which means that these people basically probably held a huge amount of their net worth in this company, and they want to move it out to mitigate risk. So just like as a financial stability decision, they're making huge sells, when in reality their company is extremely profitable and it's not really a sell anyways. But as you can see, all these are sells, and then recently we finally get a buy. And even though it's just for a tiny amount of shares, 5,000 compared to this 2.7 million sold, it signals to institutional investors in the broader market that it's too cheap and it's time to go up. It's been too cheap for a long time. A fair value for this stock is probably closer to $40 to $50. And the insiders, even though the insider ownership is already so high, are starting to recognize it and buy these shares back up. So biggest risks, tariffs and trade. So Trump has talked a lot about the 60 to 100% tariffs that he's going to put on China. If he actually does put them on, it could actually be kind of a big detriment to Gigabyte Technologies because they rely so much on transporting couches from China and other Asian places to the U.S. And if tariffs are really that high, there's probably just going to be more expensive couches that are produced in the U.S. and people are going to stop buying couches from China because they don't actually own any of the shipping stuff like the trains and the freight cargo ships and the trucks. If something goes wrong, like this is the Suez Canal, I don't know if any of you guys remember that, but if something like that happens, they don't have any control over that because they just have this couch somewhere on the cargo ship and they don't actually own the cargo ship. Asian regulations. China, I mean, they're a communist country, so the stuff that they do to the company, like data privacy, labor, and export laws, can impact operations. Then, because they're exporting and importing from so many different places to different places, and they're getting paid in different currencies, they can be affected heavily by foreign exchange fluctuations. And then also they've got competition from places like Alibaba and Amazon Business driving price wars, but really they're the best when it comes to large parcel items. So although these places are decent competition, unless these places start to move towards bigger parcel items, I still think GigaCloud Technologies is doing a better job for them. And also, all their warehouses are leased. This is kind of like a double-edged sword because it's less risk because they're not owning a bunch of warehouses, and if some place isn't doing great and they don't need that warehouse, they can stop leasing it. But it also means that they don't actually own any of their leases, and if like rent prices rise really rapidly, it could affect profits. So, conclusion. Although there are some decent risks when it comes to gig cloud technologies, their free cash flow and fundamentals are just too good to ignore. I mean, they have a forward PE of 3.8. You look at any other company, you look at Tesla, they have a PE of like 110, Nvidia like 70, and this company has a higher growth rate than any of those companies. And in addition to that, it has a baby market cap of less than a billion. And when a company has that small of a market cap, it can move and it can move fast. So I could honestly see this stock 2 to 3xing by the end of the next year as institutions and other investors start to realize how undervalued these shares are, and the insider selling stops. I predict a huge run in the stock if you're willing to hold on to a little bit of variability in the coming months.